So one of the pitfalls of working for a law office, and in particular LifePlan Lawyer, who does trusts, wills, and probates, is you get knowledge and you sometimes have to be the bearer of bad news. So one of our staff recently had a friend who was selling their home and upgrading into a larger home. And she asked, have you thought about the tax implications of that transaction? And of course the answer was yes, thought about it, we're all good, no issues. Well, unfortunately, they later discovered that there was a big issue in terms of the property sale. So I want you not to make the same mistake. I want you to be informed. Here's how things work when you sell your primary residence. So first of all, you take the sale price, what you were able to sell the property for, minus any realtor fees you might have paid. So in this example, let's say that's $1.5 million. And what you want to subtract from that is you want to subtract what you paid for the property. Okay, this is the key mistake. A lot of times people will not subtract what they paid. They want to subtract the amount of their existing mortgage. And because they may have refinanced the property several times, their mortgage may be higher than what they originally paid. So $1.5 million sale, let's say the property was $500,000 originally. That means there was a $1 million gain on this property. And from that, you can subtract $250,000 for each of the people on title if it's your primary residence. So in this case, $500,000 of the million would be tax-free, but the remaining $500,000 would be taxable at a capital gains tax rate, which could be as high as 1/3 of that amount. So don't make the mistake of using your mortgage rather than your original purchase price when doing your tax calculation. The other thing this couple was believing was that there was some way to roll over the funds that were received into a new home, and that somehow would delay the taxes or move the taxes into the new home. That concept exists in the world of rental properties, something called a 1031 exchange. Does not apply on your primary house. So it's just the $250 per person that applies there. So anyway, unfortunate news for that couple. They've got a little bit of time to plan because the tax bill won't come till next year. But please be aware that there are often taxes when you sell a house, especially when you live there a long time. And so thanks for listening, and look forward to helping you with any questions you may have.